So let's go. Hey, Pioneers, welcome to our first GTM Shorts interview. Before introducing today's guest, Stefan Mannes, let me explain what GTM Shorts interviews are about. Our goal is to create a format that is both highly educational and entertaining. So we will always invite experts from specific fields as guests to explore the impact of their expertise field on go-to-market and vice versa. Here comes the fun part, which is why it's called Shorts. The interviews will be around 20 minutes plus minus, but my guest has just 2.5 minutes to answer a question. After 2 minutes, I will give my guest a signal, and after 2.5 minutes, I will beep them out regardless of whether the sentence was completed or not. So longer discussion are reserved for our planned podcast, but in this short interviews, we aim to provide our audience with a learning experience in the shortest time possible. And if you want to dive deeper, let us know via direct message or comment. But yeah, so let's have fun. All right. Let's begin by introducing my guest for today. So he's not only a very good friend of mine, but also my business partner, which makes him my partner in crime. So the last time we had an interview together was over 8 years ago when I was invited to an interview for a team lead HR role in his business mobilejob.com. So that's a recruiting technology for non-academic or blue collar sector. And yeah, so now after working together for more than 8 years, we are like Batman and Robin, I would say. Okay, maybe it's more like Waldorf and Stadler from the Muppets. But the great thing is that we have different passion fields of business. I currently focus more on the go-to-market side, and he focused more on the financial side. So if I were to build a new business, I would be uncertain if I should raise money or not, and if yes, who should I address? I would call Stephan. So, and this brings us to the today's discussion top point: the main mistakes in finance strategies and their impact on go-to-market and vice versa. So our central hypothesis is that more than 75% of startups should not raise money from venture capitalists or other investors. This is because they do not have a solid go to market strategy and an operating system on it. As a result, they will be forced to grow their revenue without a predictable engine. And on the other hand, we have the same belief that more than 75% of startup investments would not have been made if a solid go-to-market due diligence had been conducted upfront. So let's jump into the questions. Cool for you, Stefan?
Yeah, cool.
All right. So when we talk about startup investments, for me, the first question is, what is a startup? Because maybe we have too many investments in companies that are named startups but aren't. What's your point of view here?
Great question, Christian. I've been working on and off with startups in many capacities, from being an M&A advisor to venture capital to being an entrepreneur myself. And I've always wondered what the actual definition of it is. And in preparation for our interview, I looked it up, and it's basically you're a startup by definition of our German Federal Association of Startup. If you're younger than 10 years, if you have a high growth rate in either the growth of your employees, your cash flow growth, users, blah, blah, not your burn. And if you have a certain degree of innovation in what you're doing, which is an answer to are all technology startups or are also tech enabled startups? And yes, they are. But this obviously excludes any company that isn't high growth and any company that doesn't have a degree of innovation. And obviously, the age thing, I think, is relatively useless as a metric, to be honest. But this differentiates towards, let's say, if you run an agency, even if it's a tech-enabled agency, if you don't have a certain degree of innovation, you're not a startup, right?
Yeah, so to summarize this, especially the innovation part, it's not about make your operations more efficient than, let's say, other agencies do. So it's really about innovation on the product or service you deliver to the market. So it's not an
Correct.
internal perspective, right? Yeah.
Correct. And I think the main point here, why there is so much uncertainty, is if you look at the last 15 years, starting companies, and especially technology companies, has been very, very hyped in the media. And it turned into a desired role of a career, as a person, as whatever. And this probably led to a lot of people trying to identify with the very unclear portrait that we have in the media.
Yeah, cool. Right. So we ran the time, so that was good. Second question: how does early stage fundraising shape a company's go-to-market strategy, and what are the common pitfalls companies should avoid during this phase?
That's a very interesting question because a lot of entrepreneurs, including myself, get that wrong nearly all the time. Because you look at a lot of blogs, you listen to a lot of podcasts, you're on YouTube, and you see a lot of people talking about metrics and unit economics and scaling and venture funding and angel investing, and you assume your company is a startup, you assume your company is VC based, and that you need to get venture capital in terms to get to scale, right? And that's wrong because you first have to look at the scale of your business. You have to look at your own unit economics. So, can I be profitable? Is the first question. Can my unit economics become profitable? Can I become profitable after receiving money? So, do I just need, let's say, 500,000 euros to get to profitability, and then organically my growth will increase over time? Or do I need 2 million euros to get to product market fit, to find that one out, and then move from there, right? Because as you well know, and your audience knows, there's different stages in your go to market strategies, and you practically can overlay them with your decision making and the pitfalls that you can avoid when raising. So the first question is this a VC case? And you only really know if you're in stage 3, right? So after product market fit, if you get to that next stage, then you really know if you're a venture capital case. Most companies that I know and that I've seen, and I've seen thousands of companies and pitches, most of them are not even private equity cases, which means you put in €1 and €1.20 comes out, right? There's capital efficiency. Most companies, especially in the early stages, really are just companies that need to find out, is there a problem market fit? And then if they see that, then you have unit economics that can help you further
30
adjust
seconds.
your go-to-market strategy. And then that should be the basis of it. So think about fundraising early on of avoid venture capital, try to find problem market fit, try to find product market fit. And then if you can scale, then take venture capital.
Cool, thanks. I would have thousands of questions, but this is really something more for a podcast episode. So
Sure.
therefore, let's go to the next question. Question number 3. Can you explain how a well-executed go-to-market strategy can influence investor interest and funding outcomes?
Right. So the thing is, or the one thing that you as a founder need is conviction. You're convinced that the idea that you have will be turned into a reality, right? So that's the one conviction that you have. And then you need conviction as to the way you're taking. Obviously, those things change because you have to adapt, maybe you have to pivot, blah, 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 blah. But you have to have conviction. So if you go to an investor with a not well executed go to market strategy and you're not sure about what you're pitching them and what your way forward is, so if it's not properly prepared, if you don't have a real go to market strategy, you will run into an idea of what you want to do, and because you pitched it to someone and someone gave you money for it, you will try to fulfill that exact picture that you pitched. Because most people have a big problem going back to their investors and said, remember what I told you about our flying drones? Well, it's not happening. We have to do something, right? So most people don't want to change their mind. So you should have flexibility in your go-to-market strategy. You should clearly communicate that, listen, you're giving me money to get to product market fit or to whatever stage, right? If we get to this, then we can look at this. So you should rather be cautious in your go-to-market strategy, but you should have a precise idea that you're able to kind of navigate. And the more conviction you have, the better prepared you are towards any kind of investor or financier, and the better your arguments are. But keep an open mind. Don't don't get married to any idea of what your go-to-market strategy or what your goals are, right? You need to keep flexibility.
Cool. So now the 30 seconds bell would run. So that's perfect. You're totally perfect on time.
Cool.
So let's jump to the next question. Question number 4. What are the critical financial levers a business should focus on to maximize the impact of their fundraising on their go-to-market performance?
Right. So the basic question, the way I understand it is, before I raise money, how do I need to be set up in terms of go-to-market performance to have the best outcome in terms of funding? Is that correct?
So maybe it starts already before. But it's really about when you get the money from investors, so from
Okay.
VC or
Yeah.
business angel or whatever it is,
Yeah.
on what should you focus on your go-to-market performance to make sure that the impact of your fundraised money is
Okay.
high as
So
possible. Yeah. So the lever
best
is high enough.
best dollar spent, basically, we're saying, right? Okay. So going into that fundraising process, you should be certain about your unit economics. So what's my CAC, what's my lifetime value, all of those things, and then you build hypothesis on this. That you're thinking, okay, if I can grow this channel, if I can grow this customer cohort, blah 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 blah. If you have hypotheses on those hypotheses, you should be ready to deploy money in them. And I would always suggest to have at least 2 or 3 growth channels at your disposal. So not just Facebook, not just Reddit, but a third one, right? That you can try out. And then I would take some of the money raised and make very, very specific experiments, or would execute very specific experiments, as we've done, to find out, is it really a working channel or not? And then if you are able to deploy your fundraised capital in an efficient way and get clients and lower your CAC and expand your LTV, then you need full focus on that channel or those channels, and you just need to push through them as quickly as possible. Because if you get that one thing right, you can then go back to your investors and tell them, this is what we've done, these are the results, CAC is lower, LTV is higher, this is our spend, this is the way our spend is probably going to increase, please, can I have some more money? Because if you get something to work and it really works from A to Z, there's no reason why you shouldn't get a lot more money and throw it into that channel, right? Unless the channel has some limitations. So basically my answer is, have hypothesis, execute on those hypotheses, be honest to yourself, find the 1 or 2 channels that really work, and then from that, get more money, because then you can get a higher valuation, then you can get better rights, blah, 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 all of that stuff, right?
Cool. I think that's a super interesting point. So how to use money efficiently in the best possible way. Because I think in theory it sounds super easy, but I think on the really execution side, tactical bit, it's super tough, right?
It's
Make the
super
right
tough
all the time.
But all the entrepreneurs that I've seen that have been very, very successful, they have actually used the playbook that I just described. So they found one channel and then they ruthlessly executed on that channel, and they got everything out of it. If, for example, if you look at the D2C craziness of the 2010s, right? So from 2012 to 2018, that was just all the paid social channels used up to the maximum possibility as an acquisition channel, which is why companies like Casper and the other D2C brands were able to raise as much money as possible to get as much clients as possible. Obviously, you shouldn't sell mattresses, but that's a different story.
Cool. That's even something for a podcast. So, question number 5. Could you share an innovative funding strategy that has significantly improved the company's market entry or expansion efforts?
Great question. I think if you want to improve on both ends, right? So if you want to improve on your company's overall performance and using the right fundraising strategy to be as successful as possible as a company, and getting the most out of your fundraising, I would always start in, if you really need money and you can't get it as a Förderzuschuss, a grant, or anything from the government, that's the first thing I would check out. Is there something? There's something like Exist. There's other entrepreneurship grants out there to get them. Go to an accelerator. I would spend as little equity as I have in the beginning, because equity, the shares in your business, that's your currency. So spend as little as possible in the beginning to get the problem market fit. You should actually nowadays be able to get the problem market fit with just spending your time and nothing else. To be honest, maybe a couple €100. Then you should spend as little equity as possible with, let's say, a convertible loan from a business angel that is aware of the fact that if you discover product market fit and then discover that you're not a venture case, that you will repay them. So I will find people that I can repay from a loan, invest in my business, get to really product market fit. And then once I've reached product market fit, obviously there's different decisions to go. Let's say you can bootstrap the company, grow it organically, profitably. I would always go for that, because that way you can retain as much equity as possible, right? Your own currency, and you don't need to spend it. In a perfect world, I would get a grant. Then I would get a loan. I would repay that loan with the profit out of the company, and then down the road, a couple of years,
30
if I
seconds.
think I need more money, I would just find a private equity investor, have a little cash out, safety in the bank, and enough money to grow, but not with crazy venture capital expectations.
Cool. Sixth question. What role does timing play in synchronizing fundraising efforts with the go-to-market launch, and how can companies optimize this timing?
Great question, Christian. The answer is, you need to check your realities. So it's not really that you should think about funding first, like you and I always talk about with founders and entrepreneurs. You should think about the realities of your business first, right? So your go-to-market, so your reality should inform your go-to-market strategy, and then your go-to-market strategy should inform whatever your plans are for capital raising and getting financing and stuff like that. Because, and this is something that a lot of people still forget, there is a lot of alternative investment possibilities out there, meaning there's still banks out there that give loans to businesses without giving them personal guarantees. There's mezzanine financing out there. There's specific federal and state institutions to help you get there. But to round up and answer your question, check your reality, check your unit economics, understand what kind of a business you have and you're operating, then build your GTM strategy, then think about fundraising. Those would be my priorities.
Cool. Question number 7. How can companies leverage investor networks and insights to refine their go-to-market strategies?
The answer is no. And what are we going to do with the next 2 minutes? Super easy. Answer is no. If you remember that meme, maybe you can show the meme. There's really no value add here. Investors take up your time. No, kidding aside, I've been a VC investor, so I know I have a lot of great friends that are great investors. The reality is, if you have a portfolio of 10 companies and you're talking to another 40 companies, how much time of day do you have to add value to a company? So if you're not a founder that needs something really, really urgently from a VC that can come off their network, like an introduction, the only real factors that I've heard is just fundraising. Investors know investors that know investors that know investors. So if you have any money related questions, they can usually support you in some way, because it's also in their best interest to find someone who takes more dollars, puts them in, and makes their dollars more valuable.
Love that answer. And I mean, just a no. That's a no.
Just no.
Good. Number 8. What are some emerging trends in fundraising that could impact go-to-market strategies in the next, let's say, few years?
Right. So here I'm a bit torn in between hoping and thinking this could be a reality, right? So I'm hoping that there will evolve a new class, or that we're going to see a new class of investors, institutional as well as private, that are willing to go the way of the GTM strategy, meaning patient capital, right? There's a couple of companies in the US, there's a couple here. You and I were doing it to a certain degree. So what I'm saying is, I'm seeing, and I'm hoping it grows, investors that are willing to give you money first, loan you money first to get to problem market fit, give you more money to find out if you really have product market fit, and then give you the optionality to going back to being a solo or bootstrap entrepreneur, and or giving you the possibility to grow into a private equity or venture capital case, or crazy enough to just grow yourself. It used to happen back in the old days, and we sometimes still see it. It just doesn't get hyped, right? So I'm hoping to see to seeing that there's more of that. Um, Even though there has been an insane growth in venture capital and private equity the last 15 years, we haven't seen anything according to that, while at the same time, other financing sources that entrepreneurs usually use, like banks and state and federal funds, blah, blah, have actually decreased or stagnated, right? Usually when you, or let's say 50 years ago as an entrepreneur, you would go to a bank and get a loan and then grow your business that way, right? There were different financing options. Those are not here anymore, or at least a lot of banks are not offering them anymore. You have to really go out there and find them. Um, but I'm seeing
30
an
seconds.
emergence. I'm seeing an emergence of that funding, and I would actually love to see other investors do this. Give us a call.
How should companies adjust their go-to-market strategies during different stages of fundraising from seed to Series A and maybe beyond?
Got it. So, 20 years ago, I've got introduced to the concept of equity stories. Sounds very fancy, but just describes in one sentence, what, or in two sentences, what are you pitching your shareholders? Current as well as future shareholders. So, what are you selling? And usually, you have different stages of equity stories, and you have different stages, much like you have with GTM, right? So you can actually overlay the graph, that we're always consulting, with the equity story. So you're starting from being a disruptor into becoming a partner of your B2B software clients, up until, let's say, your venture private equity unicorn case, up until becoming the new standard in how people order dog food, whatever it is, right? So your story, obviously, as much as your positioning changes within that time, and that's not just to say it's a marketing gimmick, but it should really reflect what you're trying to do. But don't limit yourself in starting off with like a grand equity story of saying we're going to disrupt the whole industry of how pet food is delivered, because you want maneuverability, you want flexibility in how you're moving forward, right?
All right, last question. Question number 10. Can you share an example or situation where a company successfully adjusted its go-to-market approach based on fundraising feedback or fundraising outcome, leading to
Yeah,
improved business performance?
absolutely. So I have many stories I can talk about, but only one that I'm allowed to talk about, which is the one that you already know because you've been part of it. So basically, for the audience, because you well remember this, we actually got market feedback that we're burning too much money, that we're not profitable enough in our unit economics, and that the tides are changing in the market. So as a result of that, we scaled back our go-to-market efforts in terms of team. We focused on the right clients. We focused on the right bookings, the right revenues, and the right bookings to revenues ratio. We focused on our costs of acquiring, the costs of maintaining clients and increasing their lifetime value. Customer facing team to less than 10, while maintaining the same amount of revenue with significantly higher profitability, which obviously led to the fact to realizing that we're not a venture case, but to the fact that we know we can be a very nice, medium-sized, profitable company with millions in revenues. Right? It's hard feedback that we got from the market, and it was a tough journey to kind of turn that around and to adjust it to the realities of the market and to adjust our go-to-market strategy. And the thing, just talking about this, realizing that the main takeaway for founders is actually don't hitch your ego to an idea of where you are as a company, because we, for example, always wanted to be a generic blue collar solution, but we know that we only well perform in certain areas with certain clients with certain setups. And instead of just narrowing our focus on those, as I described earlier, we try to be as broad as possible. And that kind of translated in a not well run GTM strategy that we had to fix, and that we fixed and were very successful at fixing. But basically, it was just ego standing in the way of doing that, right? So don't let that blind your real go-to-market realities, which is one of the reasons you and I always talk about accepting realities, even if we don't like them, and to check your biases and stuff like that.
Cool. Thanks a lot. So obviously, especially in the last question or last answer, I'm super biased, but I think there's a lot of things we could talk 60, 120 minutes about, and I would love to get the feedback from the audience, from the pioneers. But let's raise some main points as a summary of all the things I learned today. So first thing is, as a founder or founding team, you need to know very well in what stage of go to market you are, because it has a huge impact on should you raise money, and even though it is a yes, who's the right investment audience? So who should you target to be your investor? Are you a VC case or not? So that's super important to see your go-to-market stage and see the economics beyond. So that's very important. The second the second main takeaway for me is you need to be super adaptable in your go-to-market strategy, in your business idea, and maybe you need to pivot on even though this idea and business model in general. So, and therefore, maybe the feedback from the fundraising market is super relevant. But even though there's the downside trade-off that when you raise on a big story that is 30 years in the future, then you have to stick with it, maybe,
because
that was a story you
whether the realities
absolutely.
reflect that or not, and that's a trap. You're jumping into a trap, and you're not maneuverable anymore.
The third thing that I've learned, or the third main takeaway for me, is especially to go to problem market fit. So what is maybe in the past, so 10 years ago, this was really early stage of a business or of a startup. It's become super easy and cheap, so especially money wise, to go to this point. So you just have to invest passion and time and take the effort. But there's so much technology in place that you really can go there in most of the startup businesses without external investment, and that's obviously super good for your shares. So go this way and don't be a lifestyle founder. Make your hands dirty and see if you can go to problem market fit on your own, and afterwards maybe you have a good investment equity story that you can go for fundraising. And for takeaway, there's no added value on investor side. No added value. Just
I
money.
have yet to see it. If someone finds added VC value, do let me know. I'll buy you dinner.
All right. Cool. that's from my side. So this is my main takeaways. I think there are a lot of gold nuggets in this conversation. So thanks for your time, Stefan. And I think from 10 questions, I just have to tell you 5 times that 30 seconds are open, and not one time I had to beep you out. So maybe I need to reduce the time for next guest on 2 minutes. So that's the game here.
I'm a quick talker though. I appreciate your time. Those were great questions. I think you're really doing your audience a service by talking about this. I wish someone would have told me this, explained this to me. Um, I myself was drinking the Kool-Aid of venture capital, as they say. Um, and I can't even blame people for thinking about it because they don't know. So, congrats to you, and this is hoping this is real value add for your audience. So I appreciate that.
Cool. Thanks. Very appreciated.
All
So
right.
maybe if you want to use it, one last words for your side, if you want. If not, totally fine. Then we see us in a podcast. And especially you and me, we see us maybe in the next meeting in our business. But yeah, something you would like to add.
So at the risk of repeating myself and repeating what you said, try to get the problem and or product market fit on your own if you can. Understand the value of your own time and the value of your own equity, because if you commit to venture capital, most people that I know are very, very serious about it because it's other people's money, other people's hard earned, already taxed money. And then you, just speaking for myself, are also committed in terms of your own time, right? So you're committing your lifetime to this. So it's not just money. It's not just, doing slides on a Sunday night at 5. It's also you're spending your time and you're committing your time to something and you're committing other people's time. So that's very, very valuable. And you should take the time to think about what you want, and ask if things are really venture capital cases or not, if you should get investors and what your options are.
Cool. Great. Thanks for having you. And so,
Appreciate
pioneers,
it.
watch this and follow us. Follow Stefan for all fundraising topics. If you have questions, to dive deep, you can ping me all the time, but maybe you get higher value if you ping by direct message Stefan directly on LinkedIn. And yeah, so let's grow together. Let's move go to market for the future.
Awesome.